Ever wondered how supply and demand play a vital role in Forex trading? Well, you're in for a treat. Today, we'll be delving into the heart of Forex trading, exploring the critical dynamics of supply and demand. We'll touch on how to spot those golden opportunities, which indicators can give you that trading edge, and even how the smart money concept can change the way you view the Forex market. Stay tuned to unravel the mystery of supply and demand in Forex trading. First things first, let's clarify what we mean by supply and demand. At its core, supply and demand is a fundamental economic concept that revolves around the simple principle of desire and availability. Demand refers to how much or the quantity of a product or service is desired by buyers. Supply, on the other hand, represents how much the market can offer. When we talk about supply and demand, we're essentially discussing the relationship between these two forces and how they interact to determine price. Now, how does this translate to Forex trading, you ask? Well, it's quite straightforward. The foreign exchange market, much like any other market, is driven by the laws of supply and demand. In the context of Forex, demand for a currency is dictated by a multitude of factors such as the country's economic health, interest rates, political stability, and more. Higher demand for a currency typically means that its value will increase. Conversely, if there's less demand for a currency, its value will decrease. Supply in the Forex market is influenced by central banks through monetary policy, economic indicators, and geopolitical events. If a central bank, for instance, decides to pump more of its currency into the market, then the supply increases, pushing the value of the currency down. The balance or imbalance of supply and demand affects currency prices. When demand exceeds supply, prices tend to rise. When supply outstrips demand, prices typically fall. This constant interaction of supply and demand and the fluctuations it causes is what creates the opportunities for Forex traders to make a profit. It's important to note that the Forex market is incredibly fluid. Supply and demand levels are constantly shifting in response to a myriad of factors, creating a dynamic, ever-changing landscape that requires careful navigation. So, in essence, the Forex market, like any other market, operates on the basic principles of supply and demand. This is the fundamental understanding that underpins successful Forex trading. Now that we've established what supply and demand are, how do we use this knowledge in Forex trading? It all starts with identifying supply and demand zones in Forex charts. These zones, as the name suggests, are areas where the forces of supply and demand have shown significant activity. They can provide key insights into potential trading opportunities. But what do these zones look like, you may ask? Well, a supply zone typically appears as a resistance level where the price has struggled to break through. Here the market has an abundance of supply, or sellers, causing the price to stall or even drop. On the other hand, a demand zone is akin to a support level. This is where the price has found it difficult to fall below. In this area, demand or buyers outstrip supply, leading to a stall or rise in price. Now, let's talk practical. To identify these zones, it's important to look for price levels where there have been strong price movements away. This indicates a significant imbalance between buyers and sellers, or in other words, an imbalance in supply and demand. However, just identifying these zones is not enough. For a successful trading strategy, it's crucial to understand that these zones can shift over time. As market conditions change, so can the balance of supply and demand. Being able to adapt and identify these shifts is a key skill in Forex trading. It's also worth noting that not all supply and demand zones are created equal. Some can be stronger than others. The strength of these zones is often determined by the volume of trading activity. The higher the volume, the stronger the zone. Now it's time to connect the dots. By identifying these supply and demand zones and understanding their strength, you can better predict potential price movements. This can provide you with valuable information to make informed trading decisions. Identifying these zones accurately can give you a significant advantage in predicting future price movements. So keep an eye on those charts and let the forces of supply and demand guide your Forex trading journey. Identifying supply and demand zones is one thing, but how do we use this information to catch good entries? Now let's delve into the strategies for entering trades based on these zones. A key aspect of trading is timing. Spotting an opportunity isn't enough. You need to know when to jump in. Supply and demand zones provide valuable information about potential entry and exit points. This is because these zones indicate where the price is likely to rise or fall, making them ideal places to enter or exit a trade. Imagine a price chart. You've identified a demand zone where buyers have previously rushed in, causing the price to rise. The next time the price reaches this zone, there's a good chance buyers will step in again. This is your cue to enter a buy trade, anticipating a price increase. Now picture a supply zone where sellers have previously overwhelmed the market, causing the price to drop. If the price approaches this zone again, it's likely that sellers will dominate once more. Here you might consider entering a sell trade, predicting a price decrease. However, it's worth noting that not all supply and demand zones are created equal. Some may be stronger than others, indicating a higher likelihood of price movement. Assessing the strength of these zones is crucial. One way to do this is through the use of zone freshness. A fresh zone is one where price has not returned since its creation. These zones are generally stronger and more likely to result in significant price movements. Another method is to evaluate the zone origin. Zones that originate from strong moves in price tend to be more robust. The more violent the price departure, the stronger the zone is likely to be. Lastly, exercise patience. It's tempting to rush into trades, but the best opportunities often come to those who wait for the price to reach the optimal supply or demand zone. With practice, you can learn to use supply and demand zones to make informed trading decisions. Keep honing your skills and you'll soon be catching those good entries with ease. Can we improve our trading results by incorporating indicators with supply and demand analysis? Well, indeed we can. Let's dive into how we can enhance our trading with some popular Forex trading indicators. In the bustling world of Forex trading, indicators are like our trusty sidekicks. They provide us with additional insights into the market and help confirm our trading signals. For instance, the Relative Strength Index, or RSI, is commonly used to identify overbought or oversold conditions. When coupled with supply and demand analysis, it can help us determine potential reversal points in the market. Another worthy mention is the Moving Average Convergence Divergence, or MACD. This indicator helps us identify potential buy and sell signals. When used in tandem with supply and demand zones, it can provide valuable insight into the market momentum. On the other hand, the Bollinger Bands indicator provides information about volatility. If the bands are wide, it signals high volatility. Conversely, narrow bands signal low volatility. This can be incredibly useful when combined with supply and demand analysis, as it can help us anticipate potential price movements. But remember, these indicators should not be used in isolation. They should complement your analysis of supply and demand and not replace it. Because at the end of the day, indicators are tools to help you trade, not to make decisions for you. They can guide you, but the final trading decision still rests in your hands. Ever heard of the smart money concept in Forex trading? It's a bit like having a backstage pass to the world's biggest financial show. You see, smart money refers to the large financial institutions, hedge funds, and professional traders who have the resources and expertise to influence market trends. They're the puppet masters pulling the strings behind the scenes. Now, how does this tie in with supply and demand, you ask? Well, these big players create the very supply and demand we've been talking about. By understanding their movements, we can predict market trends more accurately. For instance, if smart money is buying up a currency, it creates demand, pushing the price up. If they're selling, it creates supply, causing the price to fall. Incorporating the smart money concept into your trading strategy can give you an edge. It's like having a secret code to decipher market movements. Understanding how smart money moves can give you a deeper insight into the Forex market. So, we've covered a lot of ground today. Let's take a moment to recap. We started by understanding the fundamental role of supply and demand in Forex trading. It's the driving force behind the fluctuations in currency prices. Then we delved into the practical aspect of how to identify supply and demand zones on your trading charts. We learned that these zones can help you to catch good entries, thereby increasing your trading efficiency. From there, we moved on to the role of indicators. These tools can enhance your trading by providing additional information about the market's direction. Finally, we discussed the smart money concept, which helps you understand the actions of big market players. Remember, understanding supply and demand is just one part of successful Forex trading. Continue learning, practicing, and refining your strategies. Happy trading!